What's on fire in the market and which direction is it going? Stay tuned. Hello, everyone, and welcome to January's edition of the Industry Market Update. Guys, we have an amazing update this week, and as you have all come to expect, it is going to be, it's going to be eye-opening this week. There is a lot going on in the world today. So remember to like what you see, right? If you'll like that for us, and then if you'll also hit that subscribe button, right? So that you can keep track of our Note School TV channel and everything that's going on there. And make sure and hit that bell notification so that you are notified before we go live. Remember, every Wednesday at 11:05 Central Time. So, you guys, we get a lot of questions on every show about how do I get more information about what you guys are all about, what you do at Note School, how do I attend one of those Note School one-day classes? So, guys, simply do this. Go to noteschool.com/TV, and that'll go right to us, and we will have somebody, we'll either email you back, we'll have somebody give you a call if we need to, and we will talk you through what your next steps are with Note School. So today, again, is our monthly update, and I want to bring on our leader and chief visionary officer, Mr. Eddie Speed. Good morning, sir.
Hey, Joe, how are you?
I'm good, man. It is going to be an interesting week with the Federal Open Market Committee meeting and talking about interest rates and inflation and right, what's going on?
Joe, it took us a lot to figure out what not to discuss today because there's a lot to discuss, right?
Yes, from the crazy to the we're going to see how this unfolds today, right?
We got a lot on fire in the market.
Oh my God.
And it's just going in different directions, right?
Wow.
So we're going to try to tie this together. A lot of information out there today, and a lot of things happening in the market. And so let's start out and just go through some images here, because I think it'll make sense to everybody when we do that. Little bit of old news, Joe, but headline this week was that home prices soared 18.8% in November over the year before. Right. And that's crazy. You're talking about a 20% increase in a year. That's wild. Joe, inventory drops. We are at just a tick over 900,000 units for sale.
Yeah.
I've heard people say a perfectly balanced market, and this was called a year before the virus, right? Mm-hmm. Perfectly balanced market is about 2 million properties for sale at any given time. So we are at less than 50% of that number, and pretty interesting as to where we're trending as far as the first one, Joe, is housing values.
Yep.
And we see that number pretty amazingly affected in the market.
Yeah.
And going definitely, Joe, in the direction. Whoops, I didn't mean to cross out the number there.
There is certainly not neither of those numbers are indicating they're going to go anywhere at this point, right? They've just kind of continued to steadily go up. And by the way, that is the latest numbers. And 19.6% is
the increase.
Yeah, big increase, big increase.
And look at that number. Wow.
Yeah.
From where it was in 2019. And once again, who would have dreamed that a virus would have caused this? Right.
That is very, very true that we would have People, and here's the interesting thing. You would think that with rates going up, that the affordability index is crazy right now too. I mean, it's getting harder and harder and harder, and with rates continually going up, it's people are still buying, is what I'm trying to say.
Joe, we have a housing boom.
Mm-hmm.
And we have low enough inventory levels that's probably not fixing to change here in the immediate future.
No, not
probably
anywhere in the near future.
But we have a credit crunch.
Yes.
Also in the market, and that is a void within a boom.
Yes.
And that's what we are laser focused on, because it's what we are laser focused on in our daily activities, what we're teaching, what we're doing within our, operation. Mm-hmm. And so these are numbers that we're not just doing this for Note School TV. We're doing it because we're making heavy decisions based on what we're seeing. Exactly. And I hope it's helping you with the same. Crazy numbers here, Joe, in December. And this is a lot to put on a page, and we kind of debated, should we do it? But I think some interesting things here. They didn't even call Dallas Fort Worth. They just called it North Texas. That's where I live.
Right.
And look at that. Yeah. Look at Miami.
Yeah.
And it's look at Rhode Island. That's kind of funny, and that's in the New York metro area. New York Metro is actually doing.
Well, Rhode Island, that's the entire state, Eddie. Some of these are the entire state, right? And that's kind of the thing. Some of them are just a city, some of them are a state. And you look in Alabama, for instance, and that's why those are, look at Indiana. And so, Bill McBride, he basically says, he says, no signs of slowing, even with inventory at record level, at record low levels, right?
Yeah. So basically everything is an indication of where we are in the market. And Joe, this is a little bit debatable because, there's different sources that have different kind of reflections of rent. Some say that these are actual rents. Some say that these are, what we're marketing for rents. Right. But definitely the rental tracker shows that it's jumped up 7%
in a month.
In a month, and then it's up 21% from 2020. So it's very interesting. I don't believe that anything, as we talk about with the burnout landlord, I don't think anything is measurably changed there. I think they are struggling because they're struggling managing the properties, and they're struggling with SOPs, right? Standard operating procedures for operating a rental and managing a tenant. I think that those are the things that we still see as an opportunity, but rents are definitely going up. And right here we see a sharp rise. Now, once again, these are charts that we scrape like today,
right?
But they're always dated, and that's just kind of, we just always know by the time that Redfin or Black Knight or any of these guys produce this, there's a little bit of a lag time to it, but we're not trending. There's not any immediate thing that's happened in the last 45 days that's trended us down.
Well, and understand, it takes the analytics guys, the Black Knights of the world, and the Redfins and those guys. It takes them, they take the data from the prior month, and then they have to assimilate all of that and figure out what's going on. And that's their job, right? So
just a quick note here. This was November of 2020, and this was November of 2021. Right. Just so you can see there, a little bit of a dip in here, but just look at that sharp trend right there, Joe.
Yeah.
And that was when the FOMO was definitely in the market, right? Remember that?
Yeah.
Here's another thing that I think is really important. Now, Joe, I think this chart is extreme because it says that literally there were no houses built and sold, no new homes under 200,000. Well, that can't be true because I go out in the country and I see houses that didn't sell for 200 grand that were brand new stick built houses. But call it what it is, Joe. It's a dramatic number, right? It is so down. Look at the trend line. The red represents houses under 200,000, and look at the trend line.
Yeah,
right. And the truth of the matter is look at the trend line up.
Yep. Right.
The market share of houses over 500,000. Yeah. So we've got to, there's an interesting underlying thing here to be aware of, and that's the affordability factor, Joe.
Yes.
Whether you're renting or you're buying a property and you're paying new mortgage rates, which are higher, a good bit higher than they were a year ago.
Yep.
And now all of a sudden, or you're renting, and now Joe, and you're buying gasoline at a way different price than it was.
Yes.
Those are all things to really like pay attention to in the market. I can tell you this: affordability is it's where the rubber meets the road.
Right.
Right. And it will all come back to affordability, no matter what. It'll come back to affordability.
Well,
Joe,
and
just the cumulative notice of defaults.
Yes.
Okay. And I kind of typed over the top of that number because it's slightly easier to read if we do that. Tell us what this means.
Well, so this is the number of properties that are 30 days or more past due or in foreclosure. So this, when we take all of these other numbers and we start, assimilating out what needs to come out as far as foreclosure starts and all of that, this is the real number, a little over 2 million that is literally in that foreclosure process. Now we can look at other numbers on this Black Knight report, delinquents and all of that, but this is the number right here. And it's a number plus, right? It's not just this number, but it's the number plus of what's going on out there in the market as far as stuff that, homes that are in foreclosure.
Yeah, Joe, if I totaled all of the numbers above that I circled in green here, that's what's going to get us to the 2,039,000 loans.
Right.
These are loans that are not in forbearance.
That's right.
These are loans that are delinquent and not in forbearance. And this is what has built an on fire situation for the non-performing loan business.
That's right.
And so Joe, I have bought non-performing notes since 1986.
Mm-hmm.
I started the business in 1980. We had a big real estate debacle in Texas and the Southwest, starting in 1986. And I bought a lot of delinquent notes. That was a huge focus of my business from 1986 till about 1990 or 1991. I did it again a lot in the later 90s. And obviously 2008 was a huge focus. To be honest with you, I have never bought delinquent notes in an on fire real estate market. It's my first rodeo. So I want to be clear with everybody. I'm not trying to poo-poo the on fire market or say it's bad or say I don't want it to continue, because this is like an optimum situation. We're buying loans at a discount that are going to get paid off prior to foreclosure or at foreclosure, because somebody pays more than they pay market value for the property and the customer owes less than market value. By the way, that could put some money in the customer's pocket, the borrower's pocket.
Right.
And, but it's a crazy situation. And there are 2 million loans either in a notice of default or headed for a notice of default, Joe, call it by September.
Yeah. And, Eddie, again, what you just said, to kind of put some numbers behind that, we see it through our platform, Notes Direct, and with everything else that's going on in the market out there. I mean, it's nothing to have a non-performing loan that the collectible balance is $100,000, but it's worth $180,000 to $200,000.
They're equitable delinquent notes.
Right. And and like you said, we've never seen that.
Every time I've ever bought non-performing notes, the customer was underwater. They owed way more than the house was worth. So it's a very interesting market. Joe, these are loans that are in forbearance.
Yes.
And here's an interesting thing. This is broken into categories. You know, so you've got Fannie Mae here, right? There's their piece of it. FHA, they're a piece of it. And then other loans. We're not buying Fannie Mae, Freddie Mac, FHA loans in our world, the private loan world. We're buying the other category.
Right.
About half of these loans have applied for assistance in loss mitigation, Joe. 50% of the seriously delinquent loans that are in forbearance have not applied for a mitigation plan.
Yeah, we've got a lot of data here, and I'm flipping through this right now just so that I get the correct numbers. But you know, the numbers in loss mitigation now, and people that can't do something with this is 37% of that total. So there is an inherent problem with the folks that are coming out, and they're coming out and they're not able to then make that next monthly payment, but they had to fall out, right? So they're having to reapply to try to get back in.
Yeah, this is anytime you see some big forbearance plan program, we saw this after 2008. People think, well, all these loans are modified. That's not true.
Right.
There were 10 million delinquent notes after 2008 cumulatively, right? 5 million houses became foreclosed properties.
That's right.
And about 1.5 million were in some form of a modification.
That's right.
So modifications don't necessarily represent everybody that went into forbearance. So
Eddie, let me say something about, because I found the numbers. I wanted to do this, and let me read this, because this is really the latest numbers from Black Knight show that among the 433,000 borrowers who exited forbearance during the first 19 days of November, only 40% of those are current on their loans. So of the 433,000 that exited, only 40% are current, 60% are not.
Yeah, what we're really saying, guys, is this. There is pent up inventory. We went about 2 years where nobody was getting foreclosed on.
Right.
There were well over 500,000 loans that were delinquent before the virus. We're buying those loans right now. Those are called legacy loans. Right. So we're buying loans that were delinquent before the virus started, but they weren't foreclosed on because nothing happened to them during the virus. Then obviously you had people that couldn't make payments during the virus. We have this pent-up inventory of loans that are in foreclosure or headed for foreclosure. It's a big number, and this is why the non-performing loan space has become such a topic and a conversation. So, Joe, these are forbearance plans, and if you look at it, in one sense, it's fairly easy to see that they're trending down, but this is kind of the story behind it, and that is, they're not trending down to zero. You can see over here, this is 2 million loans.
Right.
This is 1 million loans, and you can see over here, this is not some insignificant amount of loans, right? It's just under loans in active forbearance plans today, not loans that fell out. You gave another number of loans that fell out of forbearance.
Right, they came
These
out.
are active forbearance. These are about 850,000 loans. So understand, this is if you added that to the 2,039,000, Joe, we're not far from 3 million loans.
We are not. And Eddie, and just for clarification for everybody, look, all of these plans, the path to foreclosure is there for everybody. There is no eviction, and you can't go foreclose, right?
All right, so Joe, I want to talk about opportunity here. I want to hear a word from our sponsor, Note School. We explain a lot of this in beautiful, great detail in a one-day class, right? We explain where these voids are in various areas of the market, because that's where the opportunity is. Let's hear from Note School about our one-day class.
Yes.
Well, hello, everyone. It is Brian with the teaching team here at Note School, and I'm excited that I get to be the one to invite you to the upcoming Gold in Notes class. That's right. It is a one-day deeper dive class that we call Gold in Notes because of how valuable this time spent is. This is a full day that we really get to dig into the nitty-gritty, the whole world of creative financing, not just how to acquire more deals, how to get access to more capital, how to defer a lot of the taxes for us as well as for the sellers that we're talking to, and really learn how to create your own notes. And really, once you learn how to create your own notes, this is really where we spend an entire afternoon really pulling back the curtain on what the note business is, from wholesaling notes, buying and holding performing notes to really build your wealth. I'll even show you a strategy called partials, which is by far the best wealth building tool I've ever seen in the real estate space. And we're definitely going to spend some time talking about non-performing notes, which is by far the biggest opportunity in today's marketplace, solely because of the events that have happened over the past couple of years. This is when people are not paying their mortgages, and we're going to make a lot of big money from these bad debts, and we're going to help a lot of people get a second chance. It's an absolutely fantastic day. Come spend a day really digging and discover a lot of this stuff so that you too can start building your wealth. It's a day meant to really be engaging. Bring your questions, bring your comments, bring your business problems, and we will see you there.
All right, Joe. So look, we got a lot of stuff to cover here in a short period of time, but I didn't want to go without having a little story about this crazy Evergrande China thing. Tell us about it.
Well, so, we've been following this since October. Huge, biggest builder, biggest market cap of any company in China. And so they build this island, right? Ocean Flower Island. And, they did this in Dubai, Eddie, and were very successful with it. But the Chinese government has came in and said, based on the opulence of this, is what they call it, you just got to tear down all 39 of these the buildings on this man-made island. Just tear them down, right?
Oh gosh. So they made this island, they pumped this sand in there. They don't believe in the infrastructure. They don't believe that it's going to be stable. Joe, was this like a Ponzi scheme?
Well, it seems that way. The penalties in China are a little more heavy than they are here in the United States for things like that. I'm just going to say that and let it go.
Two statements I'm going to make. Somebody would say, what has China's real estate market got to do with us? Okay. We are talking about 25% of their GDP, and 70 to 80% of the household wealth is held in real estate in a market that is headed straight for the floor. Okay. And let me ask you a question. How many Chinese-owned properties are owned in the United States?
Ooh.
Okay. Just there could be opportunities ahead with an awareness of the market. So we'll keep an eye on this. Joe, we got sort of a big meeting happening here this afternoon.
Yep. Starts today. It goes through tomorrow. And this is
it started yesterday.
On the 25th. Yeah.
And then it goes today. And then the Fed chairman is going to have a press meeting this afternoon. It hadn't happened yet.
That's right.
What's he going to say, Joe?
Well, only the shadow knows, as they say. But, as we were saying, as I said before we started the recording today, or the call today, Powell has said we are not going to be influenced by what we think the stock market the stock markets potentially will react one way or another. We're going to let the chips fall where they may. And, there's a hint of 3 rate hikes this year, or as many as 6.
All right. So this is the big concern. The big concern is that the Fed has a rate hike. And let's just look at this. Now, the market's been reacting in anticipation of this. They've met yesterday and today, right? They're going to have a meeting this afternoon, and
Right.
this is red represents the markets are down. Okay, so I just took some screenshots. There's old Tesla right there, Joe.
Oh, yeah, there it is.
And this is just, I don't know what this seems to be, a red path.
A lot of red. Yeah.
That's
You
the
want to fish in the
S&P
Red Sea
right
or
there.
the deep?
The S&P is down 6% in the past week. If you looked at the three big indicators, S&P is down 6%, NASDAQ is down 7.5%, Dow Jones isn't down quite as much, 4%. And Joe, in the last month, cumulatively, they're down 10% in a month. So I was asking somebody that heavy in good solid research. I said, who is predicting a black whatever Tuesday, right, a Wednesday, or whatever it is? And he said, well, it's interesting. I think they're already feeling like it's happened. It just didn't happen in a day.
Right.
But people say, well, why does the stock market matter? Because we are definitely in an economy that affects real estate. And Joe, this, believe it or not, this could prop up areas of real estate because there's going to be an insurgence of cash, right, coming from the stock market over to the real estate market.
We called those in the last cycle. We call those stock market refugees, right? So
stock market refugees, and they gigantically affected the real estate market. Yeah. And so these are things to all pay attention to. And once again, this was on, when we refer to all three, we're referring to the S&P, NASDAQ, and to the Dow Jones. Now, Dow Jones is huge in what their stocks are, but there's not that many of them, obviously. So, Joe,
I guess we'll be waiting on pins and needles here in a few hours to see what the final remarks are, right?
Let me say something that's probably not too far out on the edge. You know, one thing about doing these shows is they're taped, and a lot of the people watch them later. Right. So whatever we say has already happened.
That's true.
And it's kind of like you're either right or you're wrong. And I keep staying some people sometimes that never take an opinion on anything.
That's right.
I want Note School to be a resource to gather information that relates back to specifically creative financing, relates to real estate, and it relates to things that affect the economy, right? But to tie it together and say we're looking for the void and the opportunity, right? We're not beating the stick going, oh, we hope housing prices drop like a rock. That's not anything near where we're thinking, right? But at the same time, there are these voids in the market. And obviously you heard Brian talking about it in that commercial, the Note School TV commercial, that for our one-day class, this is something that we focus on. Joe, oil's back up. Let's talk about how that might affect things.
Well, you've got the first one there is the West Texas Intermediate, right? Crude, which is a benchmark for U.S. oil. Look, we're, up 1.69%. These are fresh, right off the press here. And then the Brent North Sea crude is at 87.56. And there's 20 other, indexes that show that. But these are the two biggies, right? And they were all pointed up. So I just wanted to pull those two that really matter to us. And, you see it at the pumps, right? So
you see it at the pumps, and we're in wintertime. Right,
we're in wintertime,
and
right?
So that's a factor, and it goes back to the affordability. Joe, I thought this was interesting, and that is that this is the GDP trending from 1950
right
till today.
Look at that.
Right now, I thought this was an interesting little observation here. Okay. And this was from mid 50s to the mid 70s. Mm-hmm. Remember those days, Joe?
I remember those days. Yeah.
And then this is where we had the oil embargo and inflation and all of this stuff in here. And it trends below the market, right?
Right. Correct.
Right. So this was an interesting time. And in here, Joe, call it from you've heard me refer to, some things that happened in the late 80s that were some
Right.
big opportunities in the business. And, of course, obviously, look right here, Joe. This was the 2008 effect, right? Then we shot back up. But, Joe, this trend right here, which is the trend we've been in since the virus, it's a little hard not to pay attention to.
Yeah, it's a little too vertical there for my taste. Right?
We're not saying it's never happened,
Right?
but we're saying that we're trending up in a manner that is obviously this big dip in here was the first reaction to the virus, right? Which would have been obviously right in here, and that didn't take very long to fix. But we're trending up in here in an area that is certainly worth paying attention to. And by the way, here's just to remind everybody, here's the trend line.
Right.
We're getting as close to the highest of the trend line of the GDP above what the trend line is. And what are we at? 120%?
Yep.
So these are things that definitely affect some decisions. It may not affect, Joe, it may not affect any decision I make this week, right? It may not affect any decision I make in the next 30 days, but it definitely is overall something I'm paying attention to. And we'll watch the stock market situation closely. The stock market has caused real estate debacles.
Yeah.
Interest rates have caused real estate debacles. But, Joe, we have a shortage of properties for sale in the market. So I honestly think a stock market reset could drive more capital into looking for real estate.
Well, and Eddie, so this is the end of the month, right? Or this week is the end of the month, and so the things that'll be looked at, next week really as these numbers will be the inflation numbers, right? They're going to be the unemployment numbers, and that's a whole nother conversation that we won't have today, but. There's a lot of what the Fed, does, and we'll see what that looks like. So we'll see, right? It's an interesting time for sure.
It is definitely not just the normal days. We've been watching this stuff. We've been leading up to this. We've talked about various things throughout the market, but concluding where we were in 2021 and looking into 2022, lowest supply as a percentage of real estate for sale, Joe, lowest supply in century, right?
Well, that, and then, again, combined with materials and the supply chain, and that's still a big deal. Labor, right? In the home building sector. So, there's no doubt that whatever they build will sell and whatever price, but they're not building, that low price band stuff either. So,
make sure you're focused on not trying to go buy the most expensive thing.
Absolutely.
But make sure in your investing endeavors that you're searching for a void in the market. And there's some really good ones. Note School has been laser focused on some really good ones. I want to make sure that you're focused on opportunities. We've mentioned non-performing notes. We've mentioned that there's a credit crunch, right? There's a 30% less people can qualify for a mortgage than could qualify before the virus, right? We've mentioned the affordability factor. There's some definite creases in that on fire market, and that's where my heart is to make sure that you're focused on. You don't have to go just be the herd and go just overpay like everybody else. There's some creases in the market that are some bargains.
Yeah.
Joe.
And Eddie, that's what we say, man. We'll show you how to buy houses in this market and make a lot of money. So, all right. So, Eddie, I think we've covered it today. There are some, there's some interesting things that happen. We'll see how this plays out. I think next month's update will be, well, it could be real interesting as well, but, guys, again, as Eddie said, we call the market. We want to make sure that, that we're where it is and that you can operate inside of what's really happening out there. Right. So that's the thing. So we want to see you guys at a one-day class. Again, noteschool.com/TV. And just if you have any, just a question, you want to check in with us, and we'll be happy to talk to you, have somebody get back with you. So Eddie, final words?
Joe, as the old mayor of Lukenbach, Texas said one time, I'm out of soap.
We'll see you guys on the other side. Take care.
Bye-bye.
Bye.